Welcome to the Beckonomics podcast. I'm your host, Victor Beck, here alongside Hunter Beck, as we break down weekly market movements, macroeconomics, and what investors should be keying into as we look forward in this market environment. As a note, the topics discussed and opinions given are not intended to address the specific needs of any listener. This podcast is for informational purposes only and should not be relied upon for any investment decisions. Clients of Beck Capital Management may maintain positions in the securities discussed in this podcast. Well, hey, Hunter. Happy New Year. Here we are, 2024.
Yeah, great to be back. Excited to get into it. Been a long period of holidays and light on earnings, so excited to get back to some macro and micro.
Exactly. Yeah, things are kind of waking up after the new year finally, so it's exciting going into 2024. I think we should have a good year for markets this year, but certainly going to continue on this trend of macro-driven markets. Before we kind of get into what our 2024 outlook is, I'd love to recap 2023 and just kind of discuss what were the surprises that we saw in the market, what was kind of confirmed based on our 2023 outlook.
Yeah, so 2023. Great year in the markets, really, even though it didn't necessarily feel like one for most of it. We can get into it a little bit more, but a lot of big drivers of that, very concentrated, not a whole lot of breadth there, if you want to lead us into that conversation a little bit.
Yeah, absolutely. I think 2023 surprised probably most analysts on the street. I remember looking at the 2023 outlooks, in the end of 2022, beginning of 2023, and most people were relatively bearish on the market. A lot of people were expecting a recession either early 2023 or late 2023, and we just didn't see that materialize. And we have a few things that I'm going to run through, but markets reacted very positively. So the S&P was up 24%, the NASDAQ was up a little bit more than 43%, and even the Russell 2000 was up 15%. While a lot of investors still remained in cash, they were attracted by those high short-term rates. Cash maybe returned almost 5% over the year, but fortune still favored those who were invested in the equity markets. Even the bond market, by the end of the year turned positive. So we kind of avoided that subsequent year period where we have negative returns from bonds. But yeah, pretty attractive returns across the board. And so looking back at what we said in our 2023 outlook, we had a few confirmations of things that we wrote about in, going into 2023, what we were really looking for. A huge one that we're going to dive into deeper later was inflation continued to cool rather than plateau. A lot of people thought, talking about sticky inflation, thought things were going to slow down. We've continued to see inflation downtrend, and that's been a huge positive, when we're talking about the Fed trying to get to its 2% target. Another one of those was corporate resiliency. You and I were looking at companies early in 2023. They were doing a ton of cost cutting coming out of 2022, really tightening that belt. And it helped support earnings. And we think that's probably going to be a trend going forward into 2024. And then the last kind of confirmation was consumer strength. The consumer stayed strong. Some of those, coming out of the COVID era stimulus, some of those balances have been spent down to some extent. You've had credit card debt rise, to a modest level, but, we haven't really seen anything return beyond what, pre-pandemic era kind of credit card balances spending has looked like. So between the, inflation cooling, corporates staying strong, and then the consumer staying strong, that's what we really thought we were going to see in 2023. And that was pretty much confirmed.
Yeah. And so thanks, Victor. Off that, a lot of great stuff, and a lot of that's continuing into this year. And we're already seeing that in a lot of metrics, but some surprises from last year, like Victor mentioned. People were forecasting a recession in the next 6 to 9 months for the past 2 years. We still haven't really seen one. We had a short technical recession during this, if we really want to call one. But realistically, we failed to see any meaningful downturn like most analysts on the street have been expecting. Another big one that we were really hoping for was China's reopening. We're all very surprised by how subdued that growth was once they finally ended their draconian COVID practices. They got one of the world's largest economies back open, and it just failed to take off. We saw that mainly in their real estate issues. I think there's just not a whole lot of consumer confidence out there right now as far as China goes. And then lastly, volatility decreased significantly. We've been taking a look at the VIX. It's just been down. It's, even though it didn't feel like it, volatility really, pretty subdued.
Yeah, Hunter, I completely agree. I think the volatility piece was surprising to me. We entered 2023 coming out of an extremely volatile time in 2022 and really expected the markets to stay volatile throughout the year. We really got that in the first 6 months, and then a little bit again in kind of the October period. But especially going to the end of the year, volatility really fell, and that was pretty surprising, just given all the macroeconomic, geopolitical concerns going into the market. The last thing that I want to touch on before kind of going into 2024 is the phenomenon of the Magnificent Seven. So for listeners not familiar with the Magnificent Seven, those are the companies, the mega cap companies that really drove the markets forward in 2023. So being Apple, Microsoft, Alphabet or Google, Amazon, Nvidia, Meta, and Tesla. So those 7 companies made up roughly 55% of the S&P 500's return over the past year. And so, if you exclude those stocks from the S&P 500, it would have returned just over 12% compared to the 24% return. So you're talking a huge portion of that return was really just 7 companies. And, why was this the case? A lot of strategists have kind of discussed this, talked about it. A lot of that was kind of a flight to safety. Markets were down following 2022. Investors, whether it was parking in cash or parking in these big mega cap companies, wanted a safe space to put their money. And these companies continue to cash flow. And like we said, talking about corporate resiliency, they really tightened their belts and got back to a profitability standpoint that supported their EPS. So whether their revenue was still growing or not, those companies really performed well over this last year. And we expect some of them to kind of continue to be quote unquote magnificent over the next year. Our largest holding in our portfolio is Nvidia. We expect that company to do extremely well. The revenue and earnings outlooks are extremely positive, and that's going to get into our AI conversation that we're going to have in a little bit. But those companies, especially your Nvidia, Microsoft, Amazon, Meta, we expect to have see good years from those. Some of the other ones, you may see a little bit more broadening out, kind of divestiture into more areas of the small and mid cap space. And so we're very positive, I'm very positive on small and middle cap companies going into this new year. I think investors kind of ignored those over the last 12 months, and the valuations on those have not grown to the same extent that those Magnificent Seven have.
I totally agree, Victor. The Magnificent Seven is going to be, in my opinion, mostly good going into 2024. I think us, as well as most analysts on the street, are really waiting for that market broadening. We haven't seen it yet this year, but we're all really expecting that to move away from just those 7 companies and broaden out throughout the market. The one thing to keep an eye on is the Russell 2000 that we kind of use as a proxy for those small mid-cap companies now consists of 40% unprofitable companies. So a market broadening isn't going to help everyone unilaterally. We're still choosing to be very tactical and selective, even in the broader space, because a market broadening doesn't mean everybody wins. It just means more people win.
Yeah, exactly. I think, we're still looking for positive cash flow, profitability, and a good macro outlook. That's really, the core of our investment strategy, especially with debt levels, remain relatively high. Interest costs are high for those companies. So debt-laden companies are going to struggle a little bit more. Those who aren't cash flowing, aren't making a profit, they're probably not going to do as well as those others. So we're still selective in that, call it mid-cap space. But I think you're thinking about it exactly the right way.
Well, Victor, you want to get into inflation? Is it time?
It is time. So, as we mentioned, Hunter, the Fed is still going to be the main driver of the markets this year. What are they going to do, when it comes to rate cuts? I mean, the market's been all over the place. And what we saw, the reason why, equities rallied so strong towards the end of the year was, we saw at that, December FOMC meeting, Jerome Powell really pivoted as far as the, inflation conversation, the rate cutting conversation, basically declared the end of additional rate hikes, following 21 rate hikes over the last, call it, year and a half. So the Fed, we fully expect them to be done. Inflation continues to come down. And we view that as very positive for markets. Right now, the market's pricing in about an 85% chance that the first cut's going to come in March, which should be, relatively supportive of equities.
Exactly. And even in this, early this year and post Fed pivot, you've heard a lot of Fed presidents come out, maybe not so gung-ho about cuts immediately. People are kind of trying to temper those market expectations. But even they are talking about the end of QT, really a pivot sooner rather than later, even if they're not supportive of rate cuts. Rate cuts in the immediate term, which I still think, and so does the market, think that will come sooner rather than later.
Yeah, and Hunter, I know you mentioned QT. Do you want to kind of remind our listeners, what that, obviously everyone's very focused on the rate hikes, the rate cuts, QT, quantitative tightening. You want to remind our listeners, what piece that falls into when we're talking about, monetary policy?
Certainly. So QT, or quantitative tightening, as Victor told us, is mainly surrounds the Fed's balance sheet right now. Coming out of the financial crisis in '08, the Federal Reserve grew their balance sheet dramatically and continued to do so throughout COVID. So they have a lot of U.S. treasuries on their balance sheet, as well as some other debt that has begun to roll off. In the past, they buy this debt as it matures to maintain a relatively sized balance sheet. But in recent months, over the past year, the Fed's been letting that roll off the balance sheet and further add tightening pressures to the economy instead of buying it back and thus injecting more dollars as the economy has grown used to.
Right. So that quantitative tightening process really pulls more money out of the broader market. Instead of injecting cash by buying bonds, they're letting those roll off. So the supply of bonds, continues to decrease in that respect. And so you get, that kind of maintains that higher level of interest rates.
Especially given the huge deficits that the U.S. government's been running, this is a big deal because somebody needs to be out there soaking up all this treasury supply, and the Fed hasn't been there doing that recently.
Yeah, Hunter, that's something that we didn't discuss in further depth because I think we could write an entire article on it. But the U.S. government fiscal spending is a huge kind of question mark for most strategists on the street. All that bond issuance, what is that going to do to interest rates? I mean, is everyone going to continue to soak up these bonds that the government is issuing? Or is that just going to cause rates to, stay elevated for an extended amount of time? So far, we've seen, mixed results in that regard. Some of the treasury auctions have been better than others, but it's still a question that we have over 2024.
It certainly is, especially with other countries facing their own issues at home who have traditionally been large buyers of U.S. securities, really not supporting those normal levels like they have been.
So now, we kind of have talked about the Fed. What is inflation doing? Because obviously they are looking to move towards that 2% target. There's a huge mix between headline, core. From your perspective, Hunter, what is the Fed looking at, and what should we be paying attention to?
Well, the Fed is still looking primarily at PCE data. Most people quote the CPI, and inflation is continuing to move downward. And as of December of 23, core inflation was sitting at 3.9%, finally under that 4% level. And super core, something that we at Beck Capital Management have been paying special attention to, is down to only 2.2%. So super core inflation is your inflation excluding food and energy, just like core, but also excluding shelter. And shelter's been the stickiest part of inflation, primarily in our view due to how it's measured. If you look at some other numbers that have been put out, like the Zillow rental price index, it shows rental inflation coming down much quicker and back to about historical levels already. So CPI measures that as the average over 12 months, which effectively creates a 12-month lag on what's actually being observed out in the market right now. So we see that that inflation has already come down. We're just waiting for it to be reflected in the numbers. It still is, in each month, that number ticks down just a little bit more, but that will remain sticky until we get enough time for those numbers to roll in.
Yeah, no, I completely agree. I think shelter is going to create the next, call it disinflation wave that we're going to see over the next 12 months. I mean, we've already seen goods inflation is essentially flat. Sometimes it's negative on a month-on-month reading. Your broader services have come down to a large extent. And even whenever you're talking about headline inflation and things like energy and food, those have moderated to a huge extent, which while it's less important when you're talking about the core inflation figure, it's important for the consumer because, when food inflation was high, energy inflation was high over 2022, that puts a pinch, especially on your middle income, lower income consumer. And consumption drives such a large portion of GDP, about 2/3 of it. So, freeing up some cash for those individuals is a huge, huge benefit to just the broader economy and to markets in general. And the last kind of point I'll make on that is that, finally we're seeing wage growth is actually exceeding inflation. So that's a huge positive for your consumer. Corporations broadly driven by consumer spending and markets as well. And like I mentioned, GDP driven hugely by consumer spending. So now that we've got wage growth exceeding that inflation gauge, that's going to be a huge benefit for the broader economy going forward.
It really is. So do we want to talk about rate cut expectations?
Let's get to it.
What everyone wants to hear about, time for the rate cuts. So the Federal Reserve at the latest FOMC meeting laid out their forward rate expectations for the next year. That shows 2024 ending at a federal funds rate between 4.5% and 4.75% versus the 5.25% to 5.5% where we currently stand. The markets, however, are expecting a year-end 2024 rate below 4%. So there's a huge difference in what the Fed is showing and what the market is expecting. Now, here at Beck Capital Management, our expectation is somewhere in the middle. People use the federal funds futures with the market showing to hedge as well as to speculate, which pushes those down further than we think a real expectation should be. However, the Federal Reserve just recently pivoted at this latest FOMC meeting, so they're not going to be ready to forecast many rate cuts this next year. They're going to keep the higher for longer conversation going and really make the markets wait and not get too ahead of themselves in this.
Right. I think the Fed wants to continue to see progress on the inflation front. So, whether we get a cut in March or not, I think they are at least paying more attention to the risks that higher interest rates pose if they wait too long, which is a positive in our view. Means they're really thinking about what the impact of this monetary tightening is doing to the economy. But I agree. I think you were exactly right, Hunter. Somewhere in that kind of 4 to 5 cut range, probably finish the year closer to that 4% Fed funds rate is what we kind of think is likely over this next 2024 year. Now, do we kind of want to just briefly talk about, you've got, like I said before, so many people were projecting some kind of recession, slowdown, whatever type of landing in 2023. That's gotten pushed forward, to a larger extent to 2024. Do you have an opinion or thinking about, how the market's going to, or economy is going to land, quote unquote, going into this year?
I think what will determine how the economy lands is how the Fed takes the next 6 to 9 months. We discussed earlier the recession expectations that have been overblown in history over the past year or two, as well as inflation coming back down to where the Fed wants to see it. now that we're at the Fed's pivot, it's really important what next steps they take in order to not let inflation get too deflationary, because we're already seeing many goods in deflationary territory. So the Fed is almost behind the ball on this one, but also, walk that line between over easing and allowing inflation to pick back up, which I think is less of a potential risk, but is a very real risk that the Fed does not want to happen. Because the worst thing in the Fed's mind right now is for inflation to pick back up. They rather see a little too much deflation than have risk inflation picking back up at all, because that wouldn't be a good look.
Exactly. Well, if I think we've kind of talked enough about the Fed and inflation, the trends going that direction. Obviously, that's the macro level. I'd love to talk about some of the things that we think we should be watching going into 2024. What's kind of driving some of our investment philosophy, investment thesis beyond the broad macro. And so, Hunter, I think, first and foremost, obviously on the minds of investors, consumers, pretty much everybody across the marketplace is artificial intelligence. And so the way that, I feel like we are thinking about that is that, 2024 is going to be a tale of the hardware suppliers for these AI applications. You've got your huge companies, your Meta, your Google, your Alphabet, and a whole bunch of smaller companies trying to deliver AI applications, smart software that is going to kind of drive this new trend of productivity, efficiency, and just this new technology that has, so many benefits, for the broader economy. But in order to put that in place, all those companies are having to lean on those hardware suppliers. So you're seeing so many companies, just talking about first building the data centers for all of these computers that have to drive the generative AI technology, first establishing the data centers, and then the companies that are going to fill out those data centers. So you're talking about companies that are supplying the server racks, supplying the power systems, supplying the cooling. And then, your companies that are really driving that computing power, like your NVIDIAs, potentially your AMDs, and then the chip companies that are, or the fabs that are going to kind of build that infrastructure. So I think, the way that I think about it going into this year is that 2024 is going to be a tale of the hardware suppliers, and then maybe the end of 2024, 2025, that's when you're going to see these applications more emerge.
Exactly. I agree with that totally. There's a well-known saying in technology that software eats hardware. But we're currently at this spot where the picks and shovels make more sense until someone strikes gold. While people are out searching for the gold, picks and shovels all the way, it's the hardware that'll get them there. And then into 2025 and further, once people start striking gold on these software applications, software will eventually eat hardware.
Yeah, no, Hunter, exactly. I think right now those software development companies are the ones, writing the checks. What we want to see, and right now those hardware companies are the ones cashing those checks. We think, going forward, further than a year out, software companies begin cashing more of those checks than they're writing. The next thing that I think is on the mind of investors are the global political tensions. So we've got, potential, we've got current conflict, ongoing conflict between Ukraine, Russia. That seems to be in a relative stalemate, back and forth, doesn't seem to be going anywhere. The recent conflict between Israel and, the Gaza Strip, that's something that's ongoing, but likely winding down. But that's kind of conflated more into the Middle East. We've seen issues with the Red Sea lately, and that has some implications as far as shipping goes. Companies are now sending ships around the Horn of Africa rather than through the Red Sea. And so I think that brings forward, some kind of concern that, your goods prices could, inflate to some extent, because now those shipping costs have risen to higher levels than they were kind of across 2023.
Exactly. Shipping disruptions are really, in the immediate term, the most concerning part about that. As far as equity markets go, markets don't generally have issue with foreign wars if they stay localized into those areas. but the inflation potential of shipping disruptions and increased shipping prices is a real risk.
And I think that's something that we just have to keep an eye on. It hasn't gotten to an extent that we're overly concerned about at this point, but something certainly to watch as we're kind of keeping an eye on the broader macro narrative. Energy prices come into that and to some extent, and so keeping an eye on your crude oil prices, your goods prices as those tensions in the Middle East kind of develop. I think the last thing I would note is there's been continuing concern about conflict between China and Taiwan. It luckily looks like because of the state of China's economy that we kind of referenced earlier, they're not in a great place to start a massive war with Taiwan at this point. So we're hoping that at least further delays any kind of aggression in that respect. But we'll continue to keep an eye on these things. As you mentioned, I mean, U.S. market's relatively insulated from these foreign wars, foreign entanglements, but it's something to always keep an eye on, for those black swan events that could, strike the economy. So I think moving on from that, I think we'd be, somewhat negligent to not mention the fact that, we're in an election year, very contentious political environment here in the United States. It's looking more and more like, Joe Biden and Donald Trump will have a rematch. And what does that necessarily mean for markets? So historically, election years have not been a huge driver for equity markets or, bond markets. But typically the incumbent administration is going to do what they can to make sure markets stay supported, consumers stay happy, investors stay happy, to maintain that kind of control. And that's kind of the broadest point that I'd like to make in that regard.
Yeah, and beyond that, this year, half of the world's GDP faces a presidential election. Huge election year for the entire world. So beyond just the US, you have Taiwan. Going back to Taiwan-China relations, some of these candidates are much friendlier to the Chinese party than others. Some hoping to maintain the status quo and some hoping to gain even more independence from them. With so many impactful elections coming in 2024, there will certainly be a lot to look out for at home as well as abroad.
Yeah, no, Hunter, I completely agree. I think that's something for us to watch. What kind of, at least from an economic standpoint, fiscal standpoint, what are those administrations going to bring into the new year? Now, I want to talk about something fun, something a little bit, different aside from kind of the macro, the micro. And I know that this is something that you're passionate about, but we've seen some pretty exciting stuff happen in the crypto markets lately. We got some big news Wednesday. Hunter, you want to lead us through, what's going on with these Bitcoin ETFs?
Yeah, so we've had Bitcoin ETFs for a while, but they've all been based on Bitcoin futures. And so recently, we just got approval from the SEC that 11 new ETFs are now trading on spot Bitcoin prices, as well as 2 more conversions, making 13 total spot Bitcoin ETFs now. So we saw this same thing happen with gold a number of years back. The switch from pricing off of gold futures to pricing on gold spot prices. So this will allow these ETFs to track Bitcoin much more closely instead of trading at huge discounts to NAV. One of the most popular ones, Grayscale's Bitcoin Trust, was trading at a 46% discount this time last year. 46% NAV discount. That's incredible, and that's close to zero over the past days.
That's pretty substantial. Yeah, and I think moving forward, it's going to be interesting to see, will the SEC be okay with any further cryptocurrencies receiving spot ETF treatment? I think the most logical next one would be, Ethereum, Ether receiving a spot ETF. But we do know that Gary Gensler, the SEC chairman, he is not the largest fan of crypto. So that may be an uphill battle moving forward to see if any additional cryptocurrencies, at least this year, will receive some kind of spot ETF treatment.
Indeed. The most people are pointing to Ethereum as the next potential one because it's the only other cryptocurrency that has an approved futures contract. So that would naturally lead into, oh, Bitcoin gets a spot ETF. Why can't Ethereum have one? It's another cryptocurrency. They have futures ETFs. They have all of the same stuff, really, in place as far as regulation goes. So what's to prevent them from getting a spot ETF? Anyone else, it's going to be a much longer battle because you don't have all of that regulatory stuff in place to argue for a spot ETF. However, that being said, I think Ethereum's going to have to wait a little while because, as like Victor mentioned, it was a big win to get the Bitcoin ETF past Gary Gensler. I don't think he's going to be in the mood for another one anytime soon.
Yeah, no, I completely agree. But it is obviously a huge milestone for broader crypto markets, markets in general. I mean, we saw Bitcoin ETF volume above 4 billion on Thursday by the conclusion of trading, which is, one of the largest ETF launches, historically. So that was pretty fun to watch, pretty interesting for markets. We don't maintain, a huge outlook on cryptocurrencies. They're certainly volatile and speculative. They probably have a place in some portfolios, but now it does make it much easier for investors to get some kind of Bitcoin exposure. And so going from that, I think we did a great job covering our 2024 market outlook, the macro, the micro, even, bringing in crypto a little bit there. Hunter, do you have any other final notes before we close it out?
Only one final comment that if you want to look at this in any more depth, we have a 2024 outlook posted on beckcapitalmanagement.com that I'd encourage you to go read. Some very helpful charts and graphs on there as well that can make a good supplement to this conversation.
Absolutely. Thank you, Hunter. Thanks for calling that out. And going from there, we will catch you next time. Thank you for listening to the Beckonomics podcast.